Good morning, everybody. Welcome to the True Potential Do More with Your Money podcast. It is episode 68 and it is Friday, the 14th of May. Delighted to be joined this morning by George Bell, by Steve Hutton and by Jamie Sexton. Thanks for joining me this morning, everybody. What we're going to talk about today is property versus pension. Probably the common thing you hear from the man in the pub, if we can remember what a pub is. Come Monday, we'll be back in those pubs, of course. But, you know, you'll always hear from somebody who'll say, I'm not investing in a pension because I have my house. My house is worth this much money. Or I'm just going to get a rental property because it's much safer than a pension, et cetera, et cetera. And we can probably talk about some of those anecdotes as this morning's podcast gets on, and what could be good alternatives to that man in the pub investment strategy. But before we do that, George, I think we've had, we were just talking about this in the introduction, we've had a up and down week with markets. So maybe you could recap just a little bit, please.
Yeah, absolutely, Dan. Quite a bit going on this week. If I try and focus on 2 or 3 key points within the markets, which we've been discussing as a team, but also with the fund managers, which we've been sitting down with each day this week, which I'll maybe draw some of those aspects out towards the end as well, just in terms of key points, expanding a little bit further out than the week, if that would be helpful. But maybe if I kick off with some numbers in before I start, it's been a heavy week for forward guidance, for reports, for economic data prints. So markets have been a little bit more sensitive to this information. But on the week, global equities are down around 3%. If we look on a regional basis, more challenged areas are the tech sector. The NASDAQ within the US is an example. They are more sensitive to bond yields, which I'll come on to. Bond yields reflecting financing costs essentially, and that impacts the earnings which have been expected for the tech sector overall, which are strong earnings expectations. Not all regions were challenged to that same extent. In bond markets, the 10 and 30-year bonds, the yield up around 10 basis points on the 10-year, around 12 basis points on the 30-year. So you had a yield there on a 10-year government bond in the UK of around 0.9%, around 1.4% on a 30-year bond. In terms of the US 10 and 30-year, you had yields up 9 and 16 basis points to 1.7% and 2.4%. So overall, if we look at global government bonds, total return there was down around 0.6%. Global corporate bonds were down around 0.8%. So not the same magnitude of impact as what you're seeing there within the equity markets, but essentially you've seen bond yields back up a little bit there as markets try and expect where they think rates should be given the inflation backdrop. In terms of currency markets, you had the dollar, which was slightly stronger. It was up against a basket of international peers, about 0.5%. Sterling was up around 1.1%. So in context, sterling against the dollar hit around 141. Sterling against the euro hit 116 overall. So these are data points which are, yes, they're reacting to what we're hearing in terms of reports, but they're coming from a very strong place. If we think about markets, they've had a really strong first part of the year. If we look at our portfolios as an example, you've got the aggressive model, which is up 6% since the turn of the year. If we look on a 12-month basis, 25%. If we look on a 5-year basis, around 60%, around 40% for even a balanced client there. So we're talking about a very short-term period of markets with a lot of focus on data prints, which was to be expected. But if we look over the longer term there, you're still seeing that data print is coming off some very strong return numbers overall. So what caused the market movements? What have we been discussing? Well, one, and I'm going to actually go back to last Friday afternoon because it was the US jobs report. This has relevance for what we saw within Monday's markets as an example. US inflation print is probably another area which we could focus on there. So back last Friday, you had the non-farm payrolls, which is the jobs report. Essentially, analysts were expecting nearly 1 million new workers to join the labour force. Unfortunately, the target did overshoot the real number. You had just 266,000 which joined. But remember, in the US, the citizens have had these direct checks to them. They've got savings levels which are at elevated rates. So you've got savings level in the US at around 27% of disposable income, and the long-term average is around 10-11%. So they've got a bit more choice in terms of the need to return to the marketplace. That's not for everybody. It will be a greater impact to those who've got greater disposable incomes, but it adds a bit of flexibility there. In terms of the US Treasury bonds, they performed well on the back of it. The yield on a 10-year bond, which is inverse to the price, actually came in about 9 basis points to 1.47. Later on, the yield did start to pop out a little bit, so it finished around 2 basis points up on the day on Monday. But you had the Nasdaq, which is more tech focused, that responded well. As I say, you've got companies which are more sensitive to lending rates, so that was a bit more beneficial there, just on the earlier part of the week.
Just to interrupt for 1 second, George, and apologies, but that's a really interesting point about the US market with the jobs and the fact that maybe some of these the support checks have helped people raise some more income, so they're being more selective with the jobs. And find this a little bit with the UK as well, where I've got friends, we've got family as well who work in hospitality, and they've been furloughed, or some have actually, because of the way the furlough scheme works, you can actually have another job as well as still getting you up to your 80%. And hospitality are really struggling over here to actually recruit staff back in. I think there was a kind of conception, which unfortunately has proven to be a misconception, that as soon as pubs open back up, in April, and then everything opens up indoors come Monday, chefs, waitresses, bar staff, etc., would be easy to recruit again, and it's far different from that. So I wonder if some of that's going on in the US as well, where people are maybe retraining and wanting to go into a completely different industry now. I don't know, Steve and Jamie and even George, I don't know if you have similar anecdotes to me with that in terms of hospitality.
Yeah, I think, morning, buddy. I think it's going to be interesting. We had sort of this idea of what the market and the economy will be like when it reopens. And I think it won't be as any of us thought, really. It won't be this smooth path to everyone just going back to what they were doing before and growth getting back to where it was. I think it'll be a bumpy ride. But I think from my perspective, it's looking at almost using common sense now. The economy has been shut down and in mothballs for the last year. It's going to reopen, so things are going to pick up. So economic growth will pick up. It might not pick up in a uniform manner, but it will definitely start to pick up and things will start to get better again. So your investments, if you've made them, they hopefully should start to improve and keep going. But it's never as people as analysts say. And I think, Dan, your point's right. No one would have predicted that maybe some of the workers in hospitality might have been foreign nationals that have sort of repatriated to live with their families during the coronavirus. And maybe they've got re-employment in their own countries. So it's going to be an interesting few months. But certainly a lot better than it has been, that's for sure. I'm sure of that.
Yeah. I think, Steve, it's interesting that, and we were talking about this yesterday, Dan, in terms of people doing more qualifications during that lockdown period where you had a bit of time. I know I personally did 2 exams that I probably wouldn't have done if I didn't have the sort of weekends that you're stuck in the house for. And I think there has been an element of people re-educating, thinking, actually, is it time to rethink now while I'm getting paid to sort of be at home? I think we've definitely seen a sign of that. I've noticed a couple of our sort of local areas when they've started to open back up, the pubs advertising for jobs, and very few sort of taking that option. So it is interesting. I think people have looked to, is it time to look for a different opportunity now? I've got this, I'm getting paid to study. Yeah.
No, it's interesting. Apologies, George, for the interruption. I just thought it was just a interesting point crossing the US, because it's something I'm kind of seeing via adverts on Facebook and things. Every bar and restaurant I follow is asking, we need staff,
I think, Steve, you hit on a really interesting point there, which leads into the second point of the week, which is really around inflation. You mentioned that won't be even, and you will see different areas which are performing more strongly at different points in time, or at least feeling the surge of recovery and pick up in activity. So by Monday, what markets were really revving up for was the inflation prints coming out of the US, which we've been talking about quite a bit on the podcast. We've been talking about quite a bit in terms of morning markets. But when that data did come through on Wednesday, it was showing a year-on-year increase in terms of prices with inflation there from April of 4.2%. That was higher than what the markets were expecting, around 3.6%. You've got a Fed target there of around 2% there. So it was slightly higher, but that's what's printed on the front page of every newspaper, and that's what's led the bond market to react so heavily. If we actually get under the bonnet of what's driving that price, the big jump was driven by energy costs. They were up 25% year on year, but from a depressed level. If we think back, and Steve, we talked about this quite a bit last year, sort of March, April, we had negative oil futures prices trading. Now we're clearly in an environment where energy prices are back up. So you're getting a bit of a base effect come back in that sense. You've also got things such as, secondhand cars and truck prices, which increased 10%. Now, if you annualize that up, it's over 100% growth in prices. That's not sustainable. What it's reflecting is the fact that you've got semiconductor shortages across the world, and you've got these bottlenecks in terms of supply chains. You've got this pickup in demand as people are getting back out the house and actually thinking, I'll go and get that car, but I don't want to wait, 3-4 months lead time to buy a new car, buy a used car. So you're seeing an unusual spike in areas such as second-hand cars and trucks. You're seeing airfares which are up 10% because people are desperate to travel. Same with, hotels, motel rooms, and all of this sort of information which is reflecting people just getting back out the house and using more energy. And so you're seeing a bit of a base effect there. Now, what does it mean? Well, is it here to stay? Well, inflation's not a bad thing. Inflation can be viewed as a healthy growth rate. As I say, the Fed, they have a 2% target. They've got a bit of flexibility within that. But essentially what we're saying is, if we look at under the bonnet, what's happening is we see this as more of a transitory impact. Those high levels of inflation we feel will roll over, and you'll start to see a normalization as you move out through the year. The energy prices is a good example of that. If we look, that's a year-on-year number, but if we look month on month, then actually you're seeing a bit of a tapering off in those there.
I think it's two interesting points from there, George. I think the used car side of things is really interesting. I've just bought a car, and I've actually bought it as a demonstrator. I've more or less paid what was full car price, and that's because I didn't want to wait till probably February next year for it. And Jamie, we'll look at yourself. You're trying to buy a car at the minute. You can't get one.
Oh, exactly. Yeah, it's interesting. I was looking around. I kind of thought we went down to one car, but now coming back to work, you kind of want to get back to your two cars, which is probably a lot of people are in a similar situation. And you're right, trying to get the car I want in the area it's been a nightmare. Yeah,
and I think the other inflationary measure is probably just the cost of a pint of beer. If anyone's had, I went out on Saturday. It was one of my friend's 40th birthday, so we went into Newcastle. It's the first time I've been out, and by Jove, inflation's hit their price.
That's when you feel it.
Yeah, I felt it all right. I felt it in more than one way on Sunday morning, both physically and mentally when I looked at the bank statement the next day. So, yeah, again, apologies for interrupting, George. I just thought a couple of real tragic examples from my life there. So it's,
I suppose today it's all about the ECB policy meeting minutes. Central banks are in big focus at this point in time because people are really looking for clues as to, are they sticking by that massive stimulus support package which they've got? Are they going to start to taper? What's their view on growth? So there'll be a bit of focus on that today. But I think it was nice to see some green back on the board. It was a strong day for the US yesterday. Strong overnight trading session in Asia, and we're starting to see some of that wash through into Europe today. Straight from this session, I'll be going into a meeting with the investment team. We'll be discussing what we feel we were talking about this last week on the investment management special, taking all of this data, all of this information and the noise to some extent and distilling that down into what really matters. So, a couple of key points which we've been discussing with our fund managers this week, and I'll try and stick to two. I'll be pretty quick on this, but one is overall the managers are constructive on the economic recovery. That's supported by vaccination levels. Here in the UK, you've got around 52% of the population which has received at least one dose of the vaccine. In the US, you've got about 46%. In Europe, lagging behind there at around 24.7 at this point in time, but there's been a real acceleration over the last couple of weeks there. So you're starting to see an improvement there, which is supporting more so the developed world than the developing at this stage. So back to Steve's point, there is a bit of an unevenness in terms of markets overall, but the markets are, or the fund managers are convinced that the vaccine is progressing in line with the targets overall. In terms of how that translates into markets, Normally markets price a little bit faster. These expectations, we tend to get economic prints which are reflecting the previous month, the previous quarter. Markets are looking forward. The managers see a huge amount of opportunity at this point in time, not just within broad equity markets, but actually when you get under the bonnet and the divergence which you've seen in sectors. So it's a great opportunity for the true potential portfolios and our active managers who are not slavishly tracking indices but can exploit those opportunities. The final point is really just back to inflation. As I mentioned, you're seeing the base effects which are coming through, but on the other side, you've got excess capacity in labour markets, people not wanting to return back to the labour market just yet. You've had a massive amount of investment in technology and capital investment, and technology is really good in terms of improving unit productivity, which again can help mitigate some of the wage costs and business costs which are coming through in terms of unit in that sense. So that's the overall view. Fund managers viewing this as transitory. Inflation can be healthy if it's at a sustained level, or if it's at a level close to target, which the overall field will be getting back to.
Grant, thank you very much, George. And I'm just looking now, the European markets, as you mentioned, they're all green. FTSE 100's above 7,000 right now again. So yeah, all back to good. Talking about good, look, let's go back to the topic of today. And I think, gents, it might be useful if we kind of talk about some of the perceived pros really with investing with property. You know, I've been mildly glib before when I was paraphrasing the man down the pub when they say why to invest in property. But I think maybe Steve, if we wouldn't maybe kick off with you and maybe just share a couple of what some of the pros of investing in property could be, please.
When I saw the topic of this podcast, I thought, cracky, that is, on the face of it, quite a simple subject, but when you actually just think about it, it's a very complex subject. My rationale here went along the lines of property becomes a really emotional investment, and all professional investors will tell you you need to separate emotion from investment. You know, you need to base it on hard facts and hard data. And because an Englishman's home is his castle, we are, unlike many other markets, we are a nation of homeowners, or a nation of aspirational homeowners. We want to own our homes because we see there's some security there, etc. The pros of it are you have to live somewhere, as you said, Dan. And if you weren't owning it, you'd have to rent it, and you're paying rent. You know, there's always a perception, why should I pay rent to somebody else when if I can raise the money and buy my own property, I'm saving up. So it becomes really emotive. And I think then people carry that forward and look at the broader investment perspective and think, you know, property is a really good investment because I've got my house here and it's gone up in value, which is true. And generally you funded it by using debt. And then when inflation comes along, it erodes your debt. So you get to the end of your mortgage and you've purchased your house and you think that was a fantastic investment. Well, it was because you've got a house you live in and you now own. But however, if you'd have put that money to use in some other asset class, you'd have probably made a lot more money. But it's the fear of going to something you don't know. So for me, everybody should have property in their portfolio. But when I'm talking about a portfolio, I'm talking about the broader aspect of, you know, your portfolio to the general person, not a professional investor or someone who's, you know, supremely wealthy, but to the most of us, our portfolio includes where we live. So for me, I've got more than one property. Only it wasn't a conscious decision, that, by the way. I needed another property because I worked away from home, and when I moved back and was able to move back, I felt that why I was in a fortunate position, I could keep it. Why should I let someone else buy it off me and rent it out? So I, you know, rented it out. And I can talk about all the difficulties that brings as well, by the way. But you know, I'm overexposed to property, so I wouldn't buy a property fund. But equally, if that was my only investment, I would be sitting here very frightened about a liquidity trap, because if I needed to get rid of it, it can take a lot of time to get rid of property, certainly at a price you want. And so, you know, the pros of it are, yeah, it's a great diversifier in your portfolio, but you should look at your portfolio across everything you've got, not just your investment money. And I keep saying it becomes a really emotional subject. You get attached to it, and you should never get attached to investments.
Thanks, Steve. No, I agree with the emotional side of things. Even if we look from a return side of things, I think there's a common conception as well that house prices just continue to rise and up and up and up they go. And a statistic I've just been checking here, over the last 10 years, average UK house prices have risen 34.7%. And George, I'll put you mildly on the spot, but do you know how much the UK stock markets grew over those 10 years?
Yeah, you're looking at sort of north of 60%.
Yeah.
You're probably talking about 62, 64% over that point in time.
Yeah, so almost double if you were just invested just in the UK stock market versus the property side of things. And I think that's commonly missed. I think when people say, well, house prices always rise. I think house prices at the moment are artificially high as well, because we've got the stamp duty deadline coming up. Again, going back to this kind of pent up demand, which George was talking about in his investment roundup side of things. I think there's definitely this demand for a house as people have been working from home. They've been wanting more space. You've been wanting a garden. You've got the stamp duty side of things, as well, coming to a close. So maybe a bit of a bubble in terms of the housing market side of things too. Jamie, if we move to you and we maybe consider some of the tax treatment of an investment. Let's say you've obviously got a property which you own outright. Grows 35% over the last 10 years. Would you be paying tax on that?
It depends on the if it's your own property, Dan, so you won't pay any tax on it. But if it's a rented property, then yes, there is tax implications with it. And as well, if you are looking for a second property, there's areas that you consider it is different stamp duty. You pay 3% on top of the current rates. As well as you pay, if you take an income from it, that's taxable. The property purchase were very big. Steve might know. I was just a young lad at this time, Steve. But back in the early 2000s, this was it was the kind of in thing. You bought rental property because there was pretty good tax treatments on it. But the Labour government did fix that I don't know if fix the word, but they did change that over a period of time. I think that the key thing for property for me is, and a lot of people don't sort of forget about the value of the property that they sit in, which is their home. And since the increase in values that you've seen over the last 10, 20 years, you've seen a lot of people who potentially wouldn't have had inheritance tax problems have all of a sudden came into that bracket. There was a sort of a slight change where you do have a property allowance now, but it can still, if you've got a property of £500,000-600,000 and then you start put all your other assets together, you can soon get close to that figure. And it's something people forget about. They look at their other assets and forget about the actual property that they sit in. But there's various tax implications to think about. From an income perspective, stamp duty, etc. If you are looking at second properties.
And versus, I suppose, Jamie, if we use George's number, a return of north of 60%, and if you're invested in, say, just normal UK stocks and shares, and you've got tax advantages depending on if it's invested in an ISA or a pension, for instance.
Yeah, the great, I speak highly about pensions, and I know some people. But the fantastic tax efficient products, and effectively any money in a pension is sitting outside of your estate, so it doesn't come in from an IHT perspective. Regarding ISAs, obviously you're getting that tax-free growth. So you put your £20,000 in the allowance, you can get a year. And we talk about this on a regular basis on the podcast in terms of utilising your pension and your ISA allowance. But they're fantastic things for saving, and it's tax-free growth. It really is from an ISA perspective, and even from a pension perspective as well. There's tax implications on that. So I think there is definitely benefits to these types of products. And I think from my point of view with property as well, it's when you're talking about the investment side, you do have the liquidity area, which Steve talks about. But I do think sometimes when you're buying second properties and you think, well, I'll buy that second property and that'll be income for when I retire. It's the emotion of bricks and mortar that you can see it, and you're able to sort of see. There is sometimes an emotional attach to it. I don't know if that was your emotional attach to the second property you own, Steve, or just a good investment.
Has it been a good investment? Let me tell you a little bit of, I owned it, so when I moved north, I noticed the people that wanted to buy it off me were just going to rent it out. So the penny dropped. I thought, well, let's just keep it. To be honest, sometimes it can be more hassle than it's worth. You get all right, say it's a £400,000 property and you get 20 grand a year, so 5% yield. You think, oh, that's a good yield. It's better than the bank. Then you think, well, I pay agents' fees. During, an event like we've had last year, the rent stopped for a while. And then because it's managed at a distance, the decking in the garden needed replacing. So, if I was there, I'd do it myself for probably 300 quid. And they're telling me it's 6.5 grand. And then a bit of felt on the roof needs doing. And it's only a 10-year-old that was going to be 2.5 grand. And you suddenly think, I'm almost wiping out after tax, I'm wiping out any gain I've made on that property from an income perspective and the hassle. And you think, well, if that was my retirement income, I'd be sitting there thinking, crikey, I'm going to miss a year's worth of income here. So it's not all plain sailing, and it can be a real hassle. And as the guys are talking there are other asset classes that if you keep emotionally apart from, give you much better returns. Property is a good diversifier, I agree, and it maybe forms part of some people's portfolios. But just be careful. The other thing is, people think, well, I'll invest in a property fund, as we briefly mentioned a little bit there. Let's not forget a well-known property fund, the M&G fund, has been closed, just opened again after 17 months. So if you thought you wanted to take your money out, you are stuck in that liquidity trap for 17 months. Now, if you've got the cash to ride that, that's fine. If you haven't, that would be really stressful, I imagine, to a lot of people. And then you think, well, real estate investment trusts, REITs, they're an equity, everybody. They're not, all right, they're backed by property investments, but they're an equity and they behave in the same manner as equities. So it's a complex area, and you should, again, talk to people who know what, the investment managers, George and his colleagues, etc., and advisors. You should be talking to them, because it's not as simple. You just buy another house and you get a lovely income that lasts for life. It's not, in my experience, not quite the same as that.
Yeah. No, I think, Steve, there's a couple of really good points on there. I think the first one is almost a hassle factor, as well, which is you have to value your own time as well, which is, figure out how much you get paid a month, then how much that is a week and how much that is a day, and even then down how much it is an hour. And if you're having to spend, say, a day traveling backward and forward to go and meet somebody on site to do the decking and then argue the toss about, is it going to be £6,000 or 6.5, and then the felt on the roof and whatever, it could end up costing you days. It's also distracting as well. So actually, in real terms, it's costing you more because you're having to take a day's holiday, or you're having to, or if you're self-employed, you're having to move on to that rather than actually generating cash in a different way. So again, I think that's a really unseen side of things, but it's a great point, Steve. And then the second one about using, say, property as an asset type, as an asset class, and putting them into, say, your investments or pensions. I think you mentioned the liquidity thing with, you say, M&G. We had the well publicized, events with, say, the Woodford Fund over the last year as well. But George, maybe just for people who are listening and aren't aware, what do we mean when a fund gets frozen, in terms of liquidity? What does that mean?
Yeah, essentially, liquidity is all about being able to get out of your investment at a fair price. I think the second part's an important aspect, at a fair price. Essentially, and a few examples there of the M&G fund, but there was a lot of funds back in 2016 around the time of the UK European referendum. Essentially, what it's referring to is a lot of these funds were trying to sell half the city of London in the space of 3 to 5 days. It's not possible. So in that sense, they did lock up because they were buying direct bricks and mortar property. We do hold some REIT exposure within the True Potential funds. I'll just add some context to that. True Potential funds are what we call UCITS. Now, there's another acronym which I won't go too much into, but the last part of it is transferable securities, which is all about shares, so equities, bonds. It's liquidable assets. So what do we get from a REIT exposure? And you'll see this on a fact sheet, especially for, say, a balanced income type fund. You'll see about a 5% exposure. You get that exposure to capital growth, which we've discussed. You get that exposure to income in the sense of that rental income aspect. but we buy units of a fund, so you've got the ability to trade it on exchange. What does it mean? Well, it means if we want to reduce the exposure we have in the portfolios to property, we're not having to go out and put a property on the market. We're not having to deal with solicitors. We're not having to deal with surveyors who can come back and say, well, there's not much to compare the property to around here. So there was one sold down the road 10 years ago. So we'll use that as a bit of a guess. We've got something where we can take a fair value of the total assets in that property fund and get out of that quickly. So that's a really important aspect of what we do. It's a rule. It means that we can't do that in direct bricks and mortar property, but I think there's real benefits. There's also, from an outlay perspective, if you're interested in sort of having that exposure to some sort of property, you can get that within portfolio construct. You can get that within our portfolios from £1 upwards. You don't have to have all of that money sunk into that one single property on the street, and you get the phone call at 10 o'clock at night saying, I need the felt repaired on the roof and the decking's gone, and that sort of take over of your life, and the worry that is the phone going to ring tonight with the tenant on the end of the line.
No, it is a horrific worry. When I moved house, I couldn't sell my house. This is going back 10 years ago now, and I couldn't sell the house I was in. I just couldn't get the price I wanted. So we rented it out, and I used to hate it and they would phone up about anything as well. And it was the wife who I predominantly dealt with, because as the lady would often tell me, her husband was a surgeon and he's very busy, as if I care. I'm like, I don't care if he's a mechanic, But she was like, and there was one day, it was a Sunday afternoon, and the door handle fell off. And she was like, will you be able to arrange someone to come and fix the door handle? And I just replied saying, no, put it on yourself. I said, come on. And actually, it actually worked out quite well, because they hadn't had a rent review for 2 years. I said, you can put it on yourself. And by the way, I'm putting your rent up £400 a month. That quickly sorted it as well. So it was, yeah. I don't know why I've meandered into a semi-rant, which I'd actually forgotten all about until you've triggered me there, George. It's all your fault. I was having a nice morning.
It's funny that I'm in head office, as you can see, and we've got, and I'll be able to see if he's listening. Within the head office team, we've got our very own Martin Roberts, as we call him. So I'm keep waiting for him to come past. I think you know who I'm on about with the Homes Under the Hammer theme tune.
I know who you're on about. Yeah, the gentleman in concern there does not find that funny, George. He thinks he doesn't look like him, but we know it's a chap with the initials SW. That's we'll say no more from there. Jamie, you've got some exposure to house renovations and upgrades and things along with your family.
Yeah, my first property I bought was a wreck, and it was kind of like, I'll get it cheap and I'll do it up. And my dad's he's a tradesman, so he was able to help significantly, and I saved a lot of money. Now I made quite a bit on the property when I sold it, but God, what a 6 months of hell! I kind of done everything, and then we got everything done, and then I did the usual trick of I'll be able to do that, and then 10 minutes after trying, I'd ring my dad and get him to do it for us. But it was just painful. It was just really, really painful. I literally 3 years later, I bought a brand new house. I just couldn't
deal with it anymore.
Yeah, I couldn't actually cope with it. It's interesting.
I think for me, it's always the worry if you do something yourself. You always think there's a very fine time scale here till it falls off. Like I put that shelf up and I'm like, yeah, that's okay for now, but in a year's time, it's going to be down.
I remember about 3 or 4 years ago, Dan, you took the we were talking about the cost of time, which is what you were saying before. And you were taking the mickey out of us traveling to Edinburgh to get a cheap flight to New York, not realizing that I thought, I'll save myself £200 by driving to Edinburgh, not realizing I've got petrol, 2-hour drive, had to drive there, jet lagged on the way home. You just start adding up and go, actually, is it worth it? And it's the same sort.
No, that's a Greg Lang special. He'll drive to the far end of the United Kingdom to save £100 on a flight.
It's nice to hear you say you benefit from some experience there, Jamie, because harping back to your previous wisecrack about me being a little older than you, well, certain things you learn when you're a bit older.
Me and you are like mentor figures, Steve, to George and Jamie. We pass the experience down.
Well, When we moved in here years ago, I decided I'd learn how to be a plumber, because I just thought, you know what, plumbers like Meccano, I can probably do that, which is fine. I kind of taught me. It's high risk as well, plumbing, don't forget. You get the big black 5.5-inch pipes wrong, then you've got a problem. But yeah, I taught that. I didn't realise that in older life, though, I'd find it very difficult to get under cupboards and stuff. But now my lovely lady wife tells me, you can do plumbing, go under the sink and do that. So yeah, I get a lot of strange commands around this house now. So if ever you visit, I'm under the sink, it's because I can't get out.
So we'll have to come around and look at your big pipes, Steve.
It's an open invitation, everybody. Yeah.
It's very kind. No, I've got a friend, one of my best friends is an electrician, and again, going back, I wired up my own house the first time round, and the amount of electric shocks I gave myself, I think I spent like a month like shaking afterwards. But the house never burnt down, but I did get rid of it after a few years, so it may have burnt down now. It's not my problem.
You got the Dan Harrison 6-month guarantee on it.
Yeah. Go into property for a second, because it probably sounds like we're poo-pooing it, and we'll end up with a load of comments where someone will, as well as the bots, as we all seem to get in the YouTube comments, telling us how great Bitcoin is, and I invested with Bitcoin with the Dan Reed system, and you can do this. So we'll get spammed with those. Now I've mentioned the word Bitcoin, the algorithm will be picking that up. But we'll probably also get some of the property evangelists having a go at us now, because we sound very cynical and bitter about it. And it's not. I think it can. Would it be right to say, Jamie, if you stick your financial advisor hat on, would it be right to say property actually can be a legitimate part of a client's diversified like asset?
Yeah, holdings? I think it can. And when I, many occasions where we advise clients from a retirement planning perspective, we quite often say that they'll have a rental property or a few rental properties. And actually, when you're looking at, from a final salary transfer, for example, and if they've got that rental property coming in and that's going to cover the majority of their retirement income, you can benefit from transferring your final salary pension at this basis and actually taking it out of your estate and effectively tax efficiently passing it to your dependents, or your children or whoever. So there is some good benefits from that. I think it's interesting when we see these sorts of retirement plan. It is good to see, you'll have your state pension. If they've effectively got a rental property, then that works. And I think the other thing as well is I've seen a lot of clients where they've kind of wanted to help their kids out. So they've thought, well, actually, I'll help them, and I'll help them. We'll go halves on the first property, or I'll buy the first property and rent that back to them, and then they'll just inherit that, because it's important. And I think you've got that element of trying to help your family, and it's another way of gifting assets over a period of time, which once again helps with YG. So there is definitely benefits to it, but it's everything. It's circumstances, and I think when we talk about retirement, we talk about giving people advice, it's always on personal circumstances and what the client's needs and objectives are, and how that can best be achieved. So there is definitely an element for property, and I think you will always have your main asset will be your house. Whether you go for a second asset to cover income is specific to that individual, but there's other reasons why people may buy that second property.
Yeah, thanks, Jamie. And Steve, I think putting on one of Jamie's last points there, going back to myself in the introduction, where you do get the man in the pub who'll say, my house is my pension. My house is now worth £300,000. That's my pension. What's the pitfall with that statement?
Yeah, you've always got to have somewhere to live. Yeah. And people say, well, I'll downsize. Well, you might not want to downsize either. And let's not forget, if you look at 2007. We all know what happened. Even the younger people amongst us probably remember what happened in 2007. Well, house prices started going south, not literally, but in terms of price sense, went south. And they didn't regain their peak again until 2014. So you had 7 years when you would have, and we talk about the fair price for your property, you would have felt you weren't getting a fair price if you wanted to sell it and downsize. So you might have thought, well, I think the average price peaked in the UK at 189,000 in 2007 and didn't get back to that peak till something like July 2014. You would have felt robbed if you were trying to sell your house, downsize, use it as your pension. So again, it's that emotional aspect. Try and separate your emotion from your investing. I don't disagree with anything that's been said in relation to we use property as, you know, part of the portfolio and a diversifier, but don't make it your whole pension. I just think that's a really emotional phrase. My house is my pension. Well, hang on, like my kids are my pension. Well, good luck with that. There's some silly phrases that creep in, and I think people think, well, it must be true because it's a well-used phrase. No, it's not. It's probably quite a silly thing to say. Says a lot, but there you go.
No, look, Steve, I think that the 2007 is a great point, because going back to my doomed rental property, I bought my house just before that crash happened. So I bought my house at the peak, being very sensible and boring. I locked myself into a 5-year term with an interest payment of 4.2%, which was Mervyn King had just said that month. You know, I only see interest rates going up, so I thought, well, let's lock an interest rate in at that as well. Then the big crash, and it took me 5-6 years to get that house. Just actually, it's in a really desirable part of Newcastle as well, a really nice part of town, and it took me 5-6 years just to get what I paid for it back from there. And I always just think, imagine if that was my pension. Imagine if that was me relying on selling that house to then live in terms of retirement, versus an out and out proper pension like Jamie was talking about before, which is, you know, as and when you're ready to, or legally allowed, you can start drawing that down. You know, and it's, you know, you're just selling down the funds and you're getting your drawdown income payments that way.
Well, it's also, Dan, it's really difficult these days to get residential property into a pension. So it's you know, on a pension, you're getting tax relief going in, you're getting tax-free growth, and you've got an element of tax-free, you know, capital you can take out. You don't get that on a property. It is, you used to, and you refer, Jeremy, to the early 90s and stuff, when you could it was a lot easier to get your property into your pension then and get all these tax reliefs on your property. It's not easy anymore. You can't do it. And another point for me is, we talk about, and people say, oh, well, 2007 was a really, really unusual. Well, it wasn't that unusual, because last year was quite unusual. We seem to get these unusual, you know, the early 90s when we saw property deflation was really, you know, they're not that unusual, these sort of cycles in property investing. So again, don't be kidded by the fact that was a one-off. It probably wasn't.
No, and I think, you know, George is a keen student of investment. You know, markets work in cycles. You know, the investment market side of things. We've talked about that in a lot of depth before these podcasts. And, you know, as you're indicating there, Steve, it can happen with housing too. You know, so the 90s it happens, and, you know, mid 2000s it happens again. So it's, it can be a risky game to put it all in, for something which people wouldn't associate with being risky. And I think you maybe wouldn't associate being risky because you can go and look at a house. You can go and look at a commercial property, for instance. You can come and look at George if you're investing in the TPP portfolios, but George doesn't have the money inside him, so to speak. He's just, you know, it's
I think I've got 20 quid or so.
Yeah. Sorry, that's like an awful way of putting something. You can't look inside George. So
I was trying to think of an answer there, Dan, but
no, unfortunately, sometimes you can't polish a you-know-what. So so I've got myself stuck. I think that's probably, getting myself stuck probably sounds like a great thing to wrap up as well, gentlemen. That's I mean, that's been really interesting today, and it's been interesting for me as well, because I've picked up a couple of additional points there, and I hope that all of our ladies and gentlemen listening have done so too. So we're all in England, so we will speak about English lockdowns and weekends. Last weekend, before the next wave of freedom, it's raining outside, as it's done all the time, but is that going to stop anybody going out for lunch tomorrow, going out for beer garden visits? Or are you going to keep your powder dry now till Monday in the big indoors?
Well, I haven't seen my kids really for a year, Dan, and they're all coming home this weekend. So by Monday, I'll be ready not to see them again for another year, because I think we'll be sitting in a beer garden tomorrow afternoon, and I don't know what Sunday will feel like.
Yeah. Jamie, are you venturing out?
I may tease into a beer garden. I've already got a table booked for next week to have a meal out, which will be good. But I think one thing I haven't realised, which is, as everyone knows, a little boy in September, is I've had to arrange a babysitter, which is unheard of because I've never had to do this, which wasn't too hard because both grandparents were happy to help.
That's a whole new world of babysitter. And then I've got a friend, with my best friend, in fact. He used to refer when he had to look after his own children as, I'm babysitting tonight. And I'm like, you don't babysit your own children, mate. That's just called being a dad. Yeah, so never slip into that, Jamie. If Annie ever goes out and you're left alone with Jack, don't just say, I'm babysitting Jack tonight.
Definitely not. Definitely.
George, you'll be on the rampage around Newcastle.
Well, going back to Jamie's point of exams, I'm actually doing just a few more qualifications at the minute. So what my plan is, if I can get up nice and sharp tomorrow, get a good session in, then I'll head out for a beer tomorrow night, but not too many, so I can get a bit more done on Sunday. But if I get an early start in and get my head in the books, I'm sure I'll sit outside. I'm sure I'll sit in a beer garden in a tent if I need to have a pint, even if the weather doesn't hold up.
Oh no, the things we do, eh? And as I said, like when I was out last Saturday as well, it was just, it was actually really good fun to see my pals. And it's probably the same as what Steve's saying. It's nice to see, you've got family coming up, so it's nice to see friends there as well. So yeah, I haven't got a clue what I'm going to do this weekend. Probably I'm definitely not going back out on the Saturday like I did last week. No, but look, gents, again, thank you so much for helping me through this today and for putting up with some of my bits of blunders from property today. So have a lovely weekend, lads, and ladies and gentlemen, have a lovely weekend as well. I hope you enjoyed today. Please do like this video. If you did, please do comment. Please do ask questions as well. It gives us great feedback and ideas for future content as well. And if you want to hear more from us, or definitely hear more from George and the team every day with the Morning Markets, click the subscribe option as well, and you'll get a notification as and when things are ready. But thanks again, everybody. Have a great Friday and have a lovely weekend as well. Cheerio for now.
Thanks, everyone.
Thanks, everyone.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.